All right. Well, good morning and welcome to today's webinar. We're excited to have Jason Lowe and Ray Wong with us this morning to talk a little bit about commercial. Just before we introduce them, normally we would be having a commercial symposium and we'd be doing this live in Kelowna. We had to cancel last year's symposium and then this year's is off as well. But we have the dates actually for 2022. So that's the commercial symposium. If you want to mark your calendars, will be on April 28th to the 30th. So we look forward to hosting you here in Kelowna and giving you an in-person update and allows for some networking and we always look forward to that every year. You know, it's been an interesting year on the residential side. And then we put out our commercial report just recently. And I was really interested to see all the developments that have taken place on the commercial side. My name, by the way, is Derek Thorvaldson. I sort of oversee Remax Commercial for Western Canada. And we're excited to have you with us this morning. On the residential side, we've had this confluence of things happening. You've had sellers reluctant to have people traipsing around their homes in the middle of a pandemic, so they're not excited to put their homes on the market. And then you have sellers not putting their homes on the market because they worry about there's no inventory out there, so they have nowhere to go. And at the same time, you've got on the residential side, you've got low interest rates. So people want to, first-time buyers want to get in the market. You've got people that have been working from their homes and finding their homes too small and want to expand. And so they're wanting to move up or in the market. And so you have all these things working and causing the residential market to be very, very brisk and right across Canada, certainly in Western Canada. The sales are just exploding everywhere. And on the commercial side, you've got just as many interesting developments with restaurants, you know, if they don't have takeout and closings and what have you, and the industrial sector heating up because people are buying online and what have you. So it's nice to have a couple of experts sort of walk us through just what is going on the commercial side of things, because we know on the residential, there's all kinds of things happening. And we know that the impact on the commercial is remarkable as well. And if you haven't had a chance to look at the commercial report we put out earlier this year, take a look after Ray and Jason have finished speaking, it has some of the developments. Now, Altus Group has kindly provided the slide deck, so that will be available if you're participating in today's session. I want to introduce Jason Lowe is the Vice President of Go-to-Market Execution. And Ray Wong is the Vice President Data Operations with Altus Group. They have attended our previous symposiums and spoken about what's happening in the market. We're always excited to have them. And we're certainly pleased to have them here to tell us just what's happening in the commercial market today. So we're going to talk a little bit about, you know, what happened with COVID and now, you know, what we went through last year and then the impact that we're seeing develop in 2021. So without any further ado, I'm going to pass the mic over to maybe Jason or Ray. I don't know who's going first, and just tell us a little bit about what they're seeing. And Ray is going to be doing the presentation for us this morning. So which one of you two is going to start us off?
Well, I'll start. Jason usually comes out last to, he's batting cleanup, so he'll close it off for us.
If you have questions as we go through this, guys, just put them in the chat, and then I'll pass those on to Ray as he'll be focused on the presentation. But we want to answer any questions that you do have from the slides that you see, or that if you have just general questions as to what's happening in the marketplace, just put them in the chat, and we will address them. So without further ado, there you go. Over to you, Ray.
Okay, thanks, Derek. Here's a challenge with this presentation. It would basically, Jason and I have about 2 or 3 presentations a week on this thing, and from last week to this week, things changed. And last week we were talking more about the green shoots, about quantitatively easing by the Bank of Canada and less purchase of the bonds, and that the economy no longer really needs support that is still growing at a strong pace. And as of last night, there was discussion in Ontario about another sort of set of restrictions taking place on taking starting on Saturday, and before that we heard about BC and the not the closing but just takeout for the restaurants and closing of Whistler. So we are still seeing some of the green shoots with respect to Derek's comments with the hot housing market, and we're seeing some positives on the commercial investment side of as well, and as well as increase in leasing activity or inquiries across the board. Um, but a lot has to do with this the vaccine rollout and how quickly this can be rolled out across Canada. And again, almost every day you hear something a little bit different. Is there a delay? Is there a cutback? Is there some issues with logistics? So it'll be interesting to see where we go for the rest of this year. And again, until we get the vaccine, until people start feeling safe again, and we have these a little bit more consistency of if we're in a lockdown, off the lockdown and back into lockdown, because third wave will cause some disruption in the marketplace. So we're going to try to address some of these areas, but again, feel free to ask questions as we go through it. The first aspect of it is what you've been hearing a lot from the investment side with ESG and sustainable investing. And again, with this, with a lot of the owners, and it's a way of future-proofing your assets. One, continuing the expectation with tenants, with the type of buildings and the locations where they're located, and as well as the well concept overall efficiencies. But it's something that investors are demanding, not just the tenants, in mitigating some of the potential risk of the assets down the road. And now tenants are sort of demanding this as part of the criteria, or at least one of the considerations when they're looking at particular assets, especially with the wellness side, with the amenities, the air circulation, and all those aspects. But for investors, it's about future-proofing their assets down the road to make sure that it continues to be competitive with the marketplace. So we're going to probably see a lot more of this going forward, and especially as an investment criteria for especially the larger institutions and the public funds and REITs. When we look at the overall investment side, again, this is no surprise with our year-over-year number, 21, we're down 21%. And this is okay compared to the financial crisis of 2008, 2009, where we saw a decrease of about 40% of market activity. So again, we see this picking up in 2021. I mean, you look at the type of assets are sold on a national basis, that land continues to be the most dominant. It's the most dominant each and every year. But the other sectors, especially with industrial, continues to remain inactive. And this sort of the numbers within the white numbers within these bars shows you the number of transactions. So when we look at industrial, that in 2019 that there was 1,510 transactions, and in 2020 the volume's down, but there was actually an increase of 1,517 transactions nationwide. So and apartments as well, that the overall volume is down, but the number of transactions are up, and that just shows you that the impact of the private investors that are picking up the smaller assets, and as well as the limited availability regards to the larger multi-res side of it. So when we look at what's happening now, so this chart shows you the first again, the year-over-year difference for the markets across Canada: Toronto, Montreal, Vancouver, Calgary, and Edmonton. So we looked at the first 2 months of January, February 2010, 2020. So it looks like Montreal and Toronto are actually up over last year. Again, this is sort of pre-pandemic. A lot of this is sort of over the the push of fourth quarter 2020 pushing to 2021. But as you've seen so far this year, there has been a number of large portfolio announcements taking place. So we think that with respect to Vancouver, it's a lag in the numbers, that even though we're showing a 40% drop over last year, that Vancouver typically lags the market in the way of when we get the information from BC assessment. So we think it's going to end up for in the first quarter around perhaps a drop of 20 to 30%. But in contrast, Toronto, we're up 10% over last year, and so far, and Toronto numbers are almost done. But we're at between 30 and 40% increase in investment activity compared to a year ago on the first quarter. So again, that shows you the confidence in the marketplace, and I'm sure everyone's experiencing a lot more demand, especially on the private side for commercial real estate. So based on the announcements and based on the initial volume that we're seeing in the marketplace, we think that we're predicting that commercial investment activity will exceed 2020. Again, it's just based on the initial numbers. I know this chart is a little bit difficult to see, and we'll be sending you this as a copy of the slides after the presentation. And we're scrambling with this because this morning I was telling Jason that our first quarter numbers came in. So we try to get you the most recent numbers. And this is from our investment trend survey. So this is a survey of over close to about 200 of our clients across Canada. And you see that it's not a big surprise that they anticipate some upward movements, especially with what we're seeing on the office market of downtown double A office space, and as well as with regional malls and tier ones. And again, before we've never really seen this, but again, it shows you that where investors are anticipating that cap rates are going to move up for certain assets. But saying that as well, we've seen so far in the first quarter of this year increase inquiries to mall owners, especially the core tier one malls, that there's increased activity, and as well as we've seen other sort of newer tenants and foreign tenants starting to inquire or take over some of that space into the malls. Again, I think we're still going to have a little bit of challenges with some malls that are in the tertiary markets, but the anticipation is a slight increase in cap rates. And industrial continues to move downwards, and as well as on the multi-res side remains flat with a slight decrease. And what we're also monitoring is the Bank of Canada 10-year benchmark bond, and a lot what we've heard over the last couple of weeks is starting a movement of the bond rates, and it's starting to impact the 5-year mortgage rate. So that I don't think that's going to slow the residential market, and I don't think it's going to really impact that much on the commercial side in the way of demand and cap rates, because that gap is still rather large. And I think the Bank of Canada is basically sticking to their guns of not looking at increase in their prime rate until 2022/2023, depending on where the market moves towards. Okay. When you look at some of the positive impacts with this pandemic, with some of the assets, it's food anchor retail, suburban, again, apartments, and industrial land as a preference. So this is not a big surprise, but the challenge with food anchor retail is just getting your hand on those type of assets, and especially when we see the more activity with M&A activity with Sobeys and Longos out east. That it's going to create one better efficiencies, with especially the e-commerce strategy for Sobeys and especially Longos with their grocery gateway, which they were the first ones out of the gate and getting that established in the way of efficiencies and stability in grocery side, because we think that's just going to continue, especially with online and e-commerce with grocery online. So that's a preference based on our survey. And the first quarter numbers, I wasn't able to get into this, but it's it's the same trend. When we look at the other positive sector with this pandemic, this is not a big surprise. It's Vancouver. And again, our transactions so far for the first um, part of this year in Vancouver, we're averaging at 2.6%, so sub 3% cap rate, and $427 per square foot per industrial. In contrast to Toronto, Toronto has a slightly older stock of buildings compared to Vancouver, and we were only at about $310 per square foot for the beginning of this year, and the cap rate around about 3.4, 3.5%. So if you have this type of asset, and this is why there's, in addition to the user side, if you can find it, it still remains to be very strong in demand, and and users are also competing with institutional investors. And similar with the multi-res side, that we've seen increase in availability in this area. But once we go back with a regular flow of immigration and with foreign students coming back to Canada, that we think that this is a short-term increase with the overall vacancy rates on the multi-res. And as you saw for the cap rates on the multi-res side, from an investment standpoint, you just can't find enough product. And again, the product that is really moving, it's anything with either expansion or redevelopment opportunities. And on the retail side, anything redevelopment expansion is getting a lot more interest from private investors. So again, some positive aspects. In addition to this, what we're also seeing is there's a lot of noise on the life sciences side, and to a certain extent, life sciences in Canada is not as sophisticated as compared to the US. That's where you're seeing the big transactions happening, especially what Oxford and other institutions have done. The challenge in life sciences in Canada, that we're going to see this grow because of the pandemic, but it's very fragmented and it's not as well funded as compared to the US. Because if you look at a lot of the life sciences companies that are in Montreal, they're in older industrial buildings. Even though the inside is very expensive with the lab, the exterior and the cost of the buildings is still on the low end. And plus, we're probably going to see an increase in demand for data centers, and as well as storage, self-storage facilities as well. So that's what investors are looking for, sort of alternative assets, not just your core assets. We're seeing increased activity. So the first part we're sort of hitting is the office side, and this is changing, right? So based on what we saw last year, that the work from home was phenomenal, with productivity still it actually improved a little bit based on the work from home. And back a year ago, it was a discussion of, do we really need office space? And that's where we saw the sublet market start moving upwards, and as well as companies considering, not needing office space together or downsizing by 50%. This is our key assumption survey that we back in November, but it's sort of backed up with some of the reports we're seeing with some of the accounting firms that only 62% of the people that were surveyed anticipate a downsize of less than 20%. I think that number is a lot higher now. I think it's at least about 75, 80% of tenants. So we're going to still see an impact and evolution in the office sector, but not not at the same level compared to what we saw, what that we were hearing back in April and May. So we'll continue to monitor this area and to see the evolution in the office side in way of workspace dynamics as well as the type of amenities to get people back into comfortable getting back to the workspace. So with year end, again, overall increase in availability rates across the board, especially Vancouver and Toronto. And Vancouver and Calgary was a little bit high on to begin with. And again, that's because of the sublet side. If you look at the percentage of available space that's sublet, and this is starting to impact some of the rental rates or the deals in the marketplace right now. And this is again our first quarter just turned last night. So when we look at the latest numbers, it's a continued push up in regards to overall availability rates in Vancouver, Edmonton, and Calgary. And the thing is, with Calgary, the downtown Class A, as everyone knows, is plus 30%. So, and that's an overall number that we're seeing. So we're still seeing a push up right across Canada based on the availability rate and pushed by the sublet side. So again, this goes back to our assumption survey, and it looks at uh, um, anticipated rents. So anticipated rents in the downtown suburban for not just the lower quality, but on the top quality of space. So what we're seeing on the office side is the posted rents really haven't moved that much, especially for Class A. What has increased is 1 year free rent and tenant improvements rather than the posted rents. But depending on where the availability rates hit, especially if sublets hit 50% of the available space, because that's what landlords are competing against, that we'll probably see a further decline of the NERs. Plus, we probably may see some decrease in the posted rents, and we're definitely seeing a decrease in the posted rents for the B and C class buildings. So, in overall activity, we're down about half in Vancouver year over year. The good news is that you're still seeing leases happen, especially sorry, getting to the next slide, the tech sector and manufacturing resources. So that continues to be strong, especially with Vancouver. And activity is still off for this year based on lease deals, but when we speak with a number of our clients and our clients on the brokerage side, that the number of inquiries compared to last year, and again, we can't really compare to last year because it was slow all around, but they're definitely seeing increase in inquiries for both the office side and the retail side. So that remains positive. And it's the same thing with Edmonton and Calgary, and especially with possible evolution of the space and changes. So there's a lot more interest in trying to make sure that that product remains active. This is just we ran this in fourth quarter. Um, our forecast we're working on now, because we update our forecast every quarter, that we're probably anticipating a slightly higher movement in sublet space and in overall availability rates, especially a continuation of increase in availability rates into 2021 and partially into 2022 as the new space is completed. Again, the good part of this is that you're still seeing, especially with the new builds, increased activity, especially with Amazon in Vancouver, and as well as we're getting a lot more sort of tech transactions in Calgary as well. So we're starting to see some movement in that area, but anticipated higher availability rates in the downtown based on new supply and with again that push with the sublet side. On the Calgary side, again, same activity that it's about flat 2019 versus 2020. So again, lease activity is still happening in the marketplace there. E-commerce, the big jump from 2019 to 2020 as a percentage. This is not a big surprise. I'm sure everyone is experiencing the same thing I am every single day, where I'm blocked by about 20 boxes trying to get out the front door. So you're seeing that over 200 basis, no, 300 basis points, sorry, in as a percentage of growth of e-commerce, and we just see that continuing over this year and next year. We think there's going to be a bit of a fallout when we go back to the level of normalcy, but especially with grocery online, that's going to fall back a little bit. But I think we're going to still see this area still grow. We're definitely not going to see a fall in this area in the next 2 years, and that blends into what we're seeing with the demand for industrial. Similar on the rent side, this shouldn't be a big surprise. That anticipated from our survey that continued drops in rental rates in the top quality malls. But again, we're starting to see more activity inquiries for this space, and especially for the top malls that were sort of blocked out a number of the tenants in the past. Now with some of those closures, creates a little bit more of opportunity in some of the core assets. But most of our clients feel that we're going to see more pain in this area, especially on the rent side moving forward. One of the things that we're going to see as impact of e-commerce on the returns, that returns add on the operating side about 2 to 9% additional operating costs to warehouses. So the whole idea with e-commerce is for it to be functioning more efficiently, and adding 2 to 9% sort of bottlenecks it. As um, and uh, as we know that 20 to 40% of the items purchased, especially online, are returned. Less so in the stores, it's closer to about 10 to 20%, but for online items, it's usually 40 to 50%, and it's causing a bottleneck. So we're seeing this start in the U.S. In addition to the continued growth in distribution, there's going to be warehouses that are going to be dedicated just to deal with logistics, reverse logistics, with dealing with returns. And these don't have to be located in urban areas similar to the distribution right now. But we're going to see some of this maybe located further outside of the urban areas. They still need 100, 200,000 square feet to deal with this, but they don't have to be in prime real estate to get at just in time delivery or same day delivery for some of this product. So industrial is strong now, and we're anticipating it to further grow in the next 2 or 3 years of dealing with this reverse logistics part of it. Overall availability rates across Canada remains relatively tight, and this is not a big surprise to everyone. New construction, still a little bit muted. Again, it's mostly design and build, less speculative construction. That's why we're seeing low availability rates in this area. Lease activity remains strong right across the board, and in Vancouver, it increased slightly. Again, no big surprise in 2019 to 2020. Um, and this thing here, it's very painful to forecast industrial because it's going to remain flat. But there's a typical amount of new construction that hit every year that we put into our forecast. So we anticipate to stay within that 2%. The challenge with industrial, especially Vancouver, is the redevelopment of some of the industrial space out in the urban areas, and that's what's causing some of the push up in sale prices as well. When you look at the overall industrial trends, again, our first quarter numbers continued decrease in availability rates right across the board for Western Canada. When you look at the rental rates, it still remain relatively high and moving up. Industrial was the only sector that increased in rents across Canada between 3 to 5%, depending on the building. Industrial again continues to move up, and this is based on our fourth quarter because we're still waiting on the third quarter deal activity on our RealNet side of it. But you see that continue to increase. And in because Derek is is in the Okanagan Valley, we thought, what about Kelowna? So we thought we would take a look at this. The average home price is 850,000. This goes back to the work from home, right? So we saw a lot of people, you see this in the media quite a bit, that because of this work from home, people started buying their secondary properties or moving their primary residence outside of the urban areas like Vancouver and Toronto. And places like Kelowna, Ottawa, and southwestern Ontario, and Kitchener, um, it's had an impact in residential prices, right? So, and we're going to see probably a big impact in this area when we look at the office side. And this is that new UBC partnership that was announced last year, allowing for mixed use with residential, office, and some commercial. So we're probably going to see, again, depending on this work from home, because right now it's debatable. There's a lot more pressure, I think, for especially with tech firms to have people locate back into the offices. But people that, and again, this goes back to, especially on the tech side, the drive for talent and affordability. Vancouver and Toronto, because of what we've seen in the way of increase in residential prices, it's causing a bit of a concern with securing talent. And if you can have talent that can work from anywhere, still have that flexibility, I think it will work. But it'll also push up the need for co-working space. So and Derek, you can correct me on this. I did this a very quick survey with online, but there's at least plus 15 different companies of co-working space in Kelowna, and the office space is around $15 to $20 per square foot. But I think we're going to see, especially with if there's talent that or employees are located in Kelowna that still working for Vancouver companies, that they need a place to, in addition to their homes, to be dedicated and allow them to focus. So I think we're going to see co-working space continue to grow in demand, allowing for more of that type of use and demand. Because what will probably happen is that as these people reside in these areas, that will spur either their own businesses as startups and be more permanency with Kelowna. So I see this move as a positive for places like Kelowna and secondary and tertiary markets as growth opportunities for especially incubators with tech firms and other businesses, that they don't really have to have that commute, and it will spur sort of a little bit more entrepreneurship and a few more startups. And that's what we're seeing, especially in Toronto and Hamilton, especially the whole thing with affordability and the increase in demand for office space in that market. So we'll probably will see the same thing here. And on the industrial side, again, this still remains, it's actually a shortage in Kelowna in the way of service industrial. So there's a shortage of space, not just in the large markets, but in places like Kelowna and secondary markets, especially with it being between Calgary and Vancouver. So we're probably going to see this not going away in the way of demand. So it's not just the large markets, but places like Kelowna that will also experience this. And sort of as a summary, ESG will continue to have an impact on investment strategies going forward, part of future-proofing their assets. There's no right or wrong answer for office right now, and we know that availability rates will continue to go up, but we know that there's going to be more evolution of the space within the premises, especially with safety protocols and as well as amenities that will bring people back into the office. But now there has to be a reason to come back to the office. So you will see some sort of 2 to 3 day hybrid model on the office side of work from home and work in the office. But personally, I miss that synergy of bumping into Jason in the hallways and just having informal discussion. And that's how ideas are formed. You can't just do that over the screen. And that's part of the frustration over this past year of talking to the screen instead of being able to just have spontaneous discussions with my colleagues in the office that spurs different ideas. And with e-commerce, again, it's still continuing to evolve and change, and industrial demand will only get stronger. But overall commercial activity across Canada, we anticipate 2021 to exceed the volume activity compared to 2020. And we've seen that with announcements and what we've seen in the first couple of months of this year. Okay, so that's a quick overview of the commercial market. So Derek, I'm not sure if we have any questions now or if we should turn this over to Jason.
Yeah, it's interesting, Ray. When I talk to brokers across Western Canada, they all wish that their leases were coming up for renewal so that they could negotiate a better rate. And a lot of them would look at downsizing just from this aspect of, rent is a huge cost point when you in residential real estate or in brokerages in general. And so, a lot of people would like to, readjust what they're paying and how much space they have based. And I think a lot of employers have gained confidence in the workers from home. I think if you would have interviewed them about 2 years ago, they would have been, they're just going to be all in their backyards drinking martinis. Well, they found out that, boy, as I found out, when you work from home, sometimes you're starting earlier and finishing later. So so there's a lot more trust in it. And I do think that this idea of a hybrid model, I think that will be explored a lot because those of us who have been working from home like to get back to the office for that camaraderie and the networking and sharing ideas. At the same time, we find that we can sometimes being isolated allows us to focus more on certain projects and get things done a little quicker, and you can start your day a little earlier and what have you. So it's opened people's eyes, I think, as to what the possibilities are. So it's going to be interesting on how all this shakes out. I was interested to see just, the industrial space there. People are looking for more space because of returns. I find that interesting. I had no idea that was a factor, that, you have to allow for that whole return economy. Very interesting. And we'll have to see what happens. So I don't have any questions here right now. So maybe Jason, you could just tell us a little bit about Altus Group and what you guys are doing, because one of the disadvantages for Remax has is that we rely on, we don't have an internal department crunching up numbers and whatnot. So we rely on people like Altus for their expertise and for market data. So maybe you can tell us a little, Jason, about what you guys are up to.
Oh, sure. And maybe before I do that, then, again, thank you for the opportunity. There's definitely, when we talk about silver linings, and, there's definitely silver linings, and some of them of which are going to be permanent, right? Going forward as a result of the pandemic. And in terms of some of the frustrations that Ray was alluding to, I think we can both say unequivocally, one of those frustrations that we can't do this in person, right? In Kelowna. So I don't know about you, Ray. I wrote down April 28th to 30th.
I did exactly the same thing, Jason.
So listen, and listen, like there's nothing more meaningful and obviously more powerful than being able to do this in person, right? But for now, I mean, it's our current normal and we do what we need to do. But certainly both Ray and I are looking forward to that favorite annual trip that we take, more so to come out and see all of you. So, listen, we both hope that the insights shared here today are helpful to give, sort of give you some, let's say, empirical data to back up everything you're reading about and to put it into context to truly understand the impact of the pandemic. But more importantly, as Ray sort of talked about, the market response, the requirements, and then the ultimate resulting shifting demands, right, of the market, which is everything that you're seeing and what Ray has been talking about. And as we sort of go through this, we just want to share a couple of things, and more so just even like what we're hearing. Now, what you're seeing here, this is a result of an annual global property development trends report that we do. We survey all the sort of top global firms in the world. And basically, what Ray and I have been finding, and as well as our colleagues, that there's been an increasing demand for data in terms of being able to understand with empirical evidence, and more importantly, to make evidence-based decisions through unprecedented times like this, right? And quite frankly, and you heard Ray say that, like fresh out of the press, Q1 numbers, and I was a bit nervous this morning when he was putting it in, but this is like, more importantly, to deliver that insight to you. And so more and more it's becoming, I think, imperative, not just in normal market conditions that you would otherwise need data to support evidence-based decision making, but what more better time than now, right, to be able to do so, and more importantly, rely on something that's evidence-based. So effectively, without reading everything here, we're finding more and more on the development and CRE executive side of our, the survey respondents, that they're obviously, as I mentioned, looking to use this data as part of their decision making. If we go to the next slide, Ray, the other thing sort of associated with that is a consequential sort of realization that manipulating and transforming the data to put it into information that, as you saw Ray deliver to you today, that's a challenge, right? It's difficult, it's disparate, there's many sources of it. And we find ourselves as a company, and more so as a data provider / partner, being in a position, Ray, I think over the last year, right, in particular, highly focused on powering, our clients to be able to do so. If we go to the next slide, once being in a position to do that, and this is really, I think, when, when I allude to data becoming information, is to normalize it all, right? To be able to actually rely on it. And I mean, data becomes useful when data becomes information, right? More so to be able to get those insights that you heard about today, and then ultimately make evidence-based decisions. So if we go to the next slide, the exciting part for us is being able to help our clients be able to do that, right? Everything we just talked about. Part of that is the exciting release that we have with our new platform, Altus Data Studio, which took all of our data, and some of you that have used our data in the past are currently continuing to do so. We thank you for that. But more importantly is to indicate that, we had two platforms, right? And the bottom line is that everything is now being consolidated to one with substantial enhancement. This is the most important thing, to put the power in your hands, unlock the data, and let you do the analysis, because we appreciate during times like this, as well as any other time, quite frankly, that's imperative, right? To be able to take the data and conduct your analysis quickly. So think of everything we're trying to do is to put you into mission control and empower you again to make that evidence-based decision making and mitigate your risk and identify opportunities. If we go to the next slide, some of this, without getting, sort of into it, and this is not a sales pitch by any means, but it's more so just to exemplify, and more so importantly, identify how, quite frankly, even we leverage our own data, is to be able to find it quickly in an integrated manner, and then in a consistent structure, right? Otherwise, again, going back and harping the same theme, is that without consistent data that you can normalize to make and deliver on those insights to support your decision making, not very helpful. So that has been a fundamental part of what we've been trying to focus. And quite frankly, we found ourselves in, let's say, coincidental and very timely situation, given that a lot of this was all achieved during the pandemic, right? And more importantly, releasing out there supporting our clients to be able to do so. If we go to the next slide, And that is, of course, you know, and you saw Ray present all of that, taking all of the data, right, to be able to, and I think this is one of the things that, you know, differentiates us in terms of being able to power you to do that, is to do so on a multi-market, multi-sector basis, right, to have complete context of it. And, you know, to be able to get the historical trend, right, that Ray showed you. Without that historical trend, and again, what better time than to find ourselves now where that's important, right, to see what happened before during the last downturn, albeit for different impact reasons, not medical ones, right, or a pandemic, but notwithstanding, to be able to see what the market response was and then sort of measure that against what are we expecting to see, how does that sort of relate to what we're seeing, and what, more importantly, we can sort of forecast to see going forward. If we go to the next slide, and that's with respect to anything you're doing, right? Any decisions. And I think, you know, more importantly to help support your value prop to your clients, right? It's to take everything that you're seeing, get that empirical evidence to back the evidence-based decision-making to help your clients, right? Regardless of what it is they're doing and regardless of what you're helping them to do, whether that be acquire, dispose of, or develop real estate. Go to the next slide. Not the last slide, but basically at the end of the day, like, we're hoping that, you know, from everything shared with you today on the insights, and then in terms of, you know, just sort of ending it off, how we can help you, because we find ourselves in a situation where we're getting asked more and more and more to be able to do that. But more importantly, you know, we're happy to be in a position that during this sort of year plus time that we've had, we've actually, you know, come to a point where we're in a very strong position to enable that. So with that said, you know, want to thank everyone. If there's any questions, Ray and I are still happy to take that, but back to you, Derek.
Thanks, guys. I mean, one of the things as agents and practitioners, I mean, you're out there and you're selling trust, and it's one thing to have anecdotal evidence, but having hard numbers and being able to relate to different markets really establishes trust in your abilities and what have you. And so, you know, having this, having the right information and timely information, especially when you're in these kinds of markets where things are, you know, different things are happening all the time, and COVID has certainly thrown a wrench into the system. Some of it, I think, will end up being positive. We've learned a lot. But having good data is critical, I think, to any real estate agent, and especially for a commercial practitioner, because you're dealing with customers that you know, are used to and rely on analytics. And so I really appreciate the two of you spending some time with us this morning and walking us through what you guys are doing, and encourage any of the practitioners out there to reach out to Altus and find out, you know, what data is available for your local market and how you can best use it. So, you know, I want to thank Ray for his presentation, and Jason for being here being with us this morning. If you want information about, you know, different products and systems, you know, reach out to me or reach out directly to Jason or Ray, and they'll be able to walk you through it. So thanks, guys. I really appreciate you being with us, and I look forward to having you in Kelowna next year so that we can do some networking and raise a glass and to meet some of the commercial associates in RE/MAX of Western Canada. So thank you for today. We will make the slides available. I know that Ray went quite quickly through them. You know, some of you may want to take a, you know, if you're in a certain market, Calgary, or Edmonton, or Vancouver, you may want to take a little more hard look at some of those numbers. So we'll make that available to you. And again, we'll probably also make the video available to you if you want to show it to some of the other practitioners in your offices and what have you. So, all right, well, that's it for me. Thank you. I want to thank you guys again for participating, and it was very interesting, and we have a lot to sort of study from that, and we look forward to seeing you in Kelowna in 2022.
Great. Thank you.
Thank you.
Bye, guys.
Bye.
Bye.